Okay, thank you for tuning in on our discussion on corporate integration. My name is Graham Rogers, and I'm a manager in our private business group. And this presentation is to discuss the concept of corporate integration, the benefits or drawbacks of taking a salary versus a dividend, and a few tax planning considerations for business owners. So, what is corporate integration? The principle of integration is that the tax paid by a corporation and its individual shareholders should be the same as if the individual had earned the income directly. So whether the income is earned by a corporation or personally, the theory is that there should be no tax cost or savings if all of the income is paid to the shareholders. Since a corporation is a separate legal entity, they have the flexibility on when income is paid to the individual shareholders, which can create a deferral advantage. So while the concept of integration is simple in theory, there is potential for tax savings or additional costs in any given year due to the fluctuations in corporate and personal tax rates. So to help explain how a corporation creates a deferral benefit or the impact of the total taxes paid, we first need to discuss the various corporate and personal tax rates. So this slide represents the corporate tax rates across all provinces in Canada. But for this presentation, we'll just focus on British Columbia as an example. The first column shows the business limit, which means if the company meets the definition of a small business, then the first $500,000 of profits are taxed at the lower small business rate. So in the next column, you'll see that the provincial small business rate in BC is only 2%, while in the next column, if the corporation is not eligible for the small business rate, the provincial rate is 12%. This is otherwise known as the general rate. When you combine the provincial and federal rates, small businesses effectively pay 11% in tax up to the business limit, and then the general tax rate goes up to 27%. So this slide shows the personal rates for income earned at the top marginal tax brackets. In BC, the top marginal bracket is any income that's earned over $220,000. So for regular employment income, any dollar earned in excess of $220,000 will be taxed at 53.5%. Capital gains, for example, gains on selling stocks, are only 50% taxable, so they are taxed effectively at 26.75%. Now, dividends receive a different tax treatment. An eligible dividend has a lower tax rate because they're paid from profits that were taxed at the higher general rates in a corporation. So the rate is around 36.5%. An ineligible dividend is paid from a corporation that was taxed at the lower small business rate. So the theory of integration applies here, and therefore the individual would pay a higher rate of tax, which is just under 49%, so that the total tax would be similar if an individual earned that income directly. So to demonstrate the cost and benefit of having a corporation, this slide shows three different scenarios of having $100,000 of income go through a corporation versus earning it personally. The first column is a corporation that earns income at the general rate of 27%. So in this example, the corporation would pay $27,000 in tax, and the remaining $73,000 is then paid to the shareholder at the lower eligible dividend rates. The total tax paid in this scenario is $53,674. If there is no corporation, the individual would earn that $100,000 as a salary, and using the top marginal rates, the taxes paid would be $53,500. So earning the salary directly results in actually paying slightly less tax of $174 compared to having that income flow through a corporation. So here the theory of integration is almost working, but it's not perfect. At the bottom, you will see the deferral benefit of having a corporation, which is the difference between the tax on the salary earned directly versus paying the corporate tax and not paying out that dividend. So here we see a potential deferral benefit of $26,500 because a corporation has the flexibility to not pay the corporate income out as a dividend, leaving more after-tax dollars to retain in the corporation and reinvest in the business. The second scenario shows the income if it were taxed at the small business rate and then after-tax income paid as an ineligible dividend. Here we see the total tax a bit higher at $54,500 and ultimately costing an additional $1,000 in tax compared to earning that income directly as a salary. However, since the small business tax rates are significantly lower, there is a much larger deferral benefit of $42,500, which is a great advantage for small businesses to retain those profits in the corporation. Finally, in the last column, this is a scenario for a corporation that earns passive investment income from a stock portfolio, for example, is taxed at a much higher rate in the corporation and ultimately leads to additional tax costs of $5,600 and a very small deferral benefit of $2,800.
So my name is Jason, and I'm also a manager in the private company group here at Manning Elliott. So I'm going to be discussing the differences between paying yourself a salary versus paying yourself a dividend. So it is important to note that one option isn't necessarily better than the other. It really does depend on your personal situation. So first, we will start with paying yourself a salary. So a salary is deductible from a company's taxable income. So in turn, your corporation's tax liability will be lower each year if you opted to choose paying yourself a salary versus a dividend. Additionally, if you are interested in making RSP contributions, a salary does qualify as earned income, so it allows you to build up your RSP contribution room each year. Now, the one kind of drawback is salaries do require you to remit source deductions as the salaries are being paid throughout the year, which would include your Canada Pension Plan, so CPP, as well as income tax. Although this is more of an administrative burden, it does help avoid that kind of large tax bill when you do file your tax return at the end of the year. You're effectively kind of prepaying your tax throughout the year, which some people do prefer. Another kind of, I guess, benefit to the fact that you have to contribute to CPP is that when you do eventually retire, you're eligible to receive CPP benefits. Another benefit to paying yourself a salary is that when you're trying to obtain financing or a personal mortgage, salary income is usually more consistent and steady in comparison to a dividend, which is more preferable in the eyes of lenders. All right, another benefit is that you do have the ability to income split if your spouse or family member is actively involved in the business. And this is the case even if they're not a shareholder. It is, however, important to note that salaries paid to family members must be reasonable given the level of work that they're doing. So for example, you can't be paying your spouse $100,000 if they're doing five hours of work per week. In addition, if you do have children, another benefit for salaries is that you are able to deduct childcare expenses on your personal tax return. If you, for example, are only earning dividend income, you actually are not eligible to be able to deduct your childcare expenses. And lastly, something new that just came to BC as well is something called the Employer Health Tax, also known as EHT. So BC companies must pay EHT of 2.925% on their salaries and wages in excess of $500,000. If their salaries and wages are greater than 1.5 million, then the EHT is 1.95% of the company's total salaries and wages. This is also applicable in other provinces such as Ontario, Quebec, Manitoba, and Newfoundland. However, those rates do slightly differ. All right, so now on to dividends. So unlike salaries, dividends are paid with after-tax corporate earnings, so they are not a deduction to the company in the year that they are paid. Once again, unlike salaries, with salaries, you are required to pay CPP. With dividends, you are not. So that is one kind of initial tax savings up front, or cost savings up front, sorry. But the one kind of drawback to that is that you won't be able to collect CPP when you do retire. And again, that's making the assumption that you are only paying yourself a dividend and you're never paying yourself a salary. Further, dividends do not qualify as earned income. So if you are someone that likes to kind of max out your RSP contributions each year, dividend income does not build up your RSP room. So that is something to consider as well. Going back to the example of paying your spouse $100,000 if they're only working 5 hours a week. Unlike salaries, dividends are not subject to a reasonableness test. So, if your company is super profitable and you had, $500,000 of after-tax earnings and you wanted to pay yourself that, you are more than welcome to do so without kind of meeting any sort of test. And dividends can also only be paid to shareholders of the company. So if you, for example, you do have, a spouse or an adult family member that is actively involved in the business, if they are not a shareholder, you are not allowed to pay them a dividend. Now, there are the new rules that have been put in place in regards to tax on split income that does make it a bit more difficult to income split with your spouses or your adult children. These rules are fairly complex, so we do advise that you do get in touch with us so we can better analyze your specific situation. All right, so the final question, salary versus dividend, which is better? Kind of like I said at the beginning of the presentation, the simple answer is it really does depend on your personal situation. Everyone's situation is different. For one person, a salary might be better versus a dividend for someone else. But there are some general questions that you should consider, such as, do you have childcare expenses? Are you wanting to maximize your RSP contributions each year? Does your company earn investment income? In that example that Graham was previously speaking to, companies that earn investment income pay a higher rate of tax, so you are able to recover some of those taxes if you pay a dividend. Another question to consider is, do you have a spouse or an adult family member who is a shareholder and actively involved in the corporation? And I think most importantly, it is important to note that it doesn't have to be one or the other. Sometimes a mix of salary and dividends is the most beneficial option. But once again, it does depend on person to person. So now I will pass it over to Mike.
Continuing Graham's discussion on corporate integration, there are a few rule of thumbs for 2020. The most important one is that active business income in a corporation still provides a tax deferral opportunity, but that tax deferral opportunity only exists if the corporate surplus is left in the corporation. Conversely, if the corporate surplus is distributed from the corporation as a dividend, and that individual would rather be taxed at a highest marginal rate if they receive that income, there's a slight tax cost on the flow through of that active business income to an individual. What that means is if all the corporate earnings would have to be extracted from a corporation, you would want to be looking at doing a bonus or a wage rather than a dividend to avoid that slight tax cost, but that bonus or wage has to be supportable by the corporation in order to be deductible. And then for certain provinces, there's a slight deferral opportunity on passive investment income earned by a Canadian controlled private corporation, which is counterintuitive to the way the regime had worked in the past. Here's a summary of the deferral opportunities in BC when earning income in a Canadian controlled private corporation. So for passive investment income, there's a 2.8% tax deferral opportunity. Capital gains are taxed at 50% of resulting in a 1.4% tax deferral opportunity. Eligible dividends earned by portfolio dividends. So let's say you have marketable securities, you receive dividends on those marketable securities. The corporate tax that you pay on that is 1.8% higher than the tax you would be paying as an individual. So the general recommendation on portfolio dividends received from your marketable securities, if they're eligible dividends, is to flow those eligible dividends out to an individual, recover the tax that was paid by the corporation, and then pay tax on those eligible dividends at the person's marginal tax rate, which is lower than the tax the corporation would have had to pay. Non-eligible dividends, there's a slight deferral opportunity there. Active business income earned at the small business rate, that's where the largest tax deferral opportunity exists. And then active business income in excess of the small business rate, while a large benefit is not quite as large as having access to the small business rate. Since the federal 2020 budget is not forthcoming and no changes to the federal tax rates are anticipated, this is an illustration of where we were in 2019 before the BC provincial tax rate increases, and in 2020 after the increased tax rate on the highest marginal tax bracket. So you can see here there was across the board an increase in taxes payable, 3.7% on ordinary income, which is salary, interest, bonus, business income, other remuneration earned at the top marginal rate. Capital gains are taxed at 50% currently, so their increase is 1.85%, which is 50% of that 3.7% increase. Eligible dividends received from a Canadian corporation had the largest increase at 5.10%. And the non-eligible dividends received from Canadian corporations had an increase of 4.25% at the highest marginal tax bracket in BC. So you can see here that our tax rates here in BC are quite high. So if we think back to the previous slide where there's large tax deferral opportunities, though some of those tax deferral opportunities, such as the tax deferral opportunities on passive investment income and earned by a Canadian controlled private corporation, it's simply driven by the the absurdly high rate of tax that we're paying in BC right now. We'll have to see where we go for 2021. Hopefully it doesn't increase, as the non-eligible dividend rate of almost 49% now is what the high rate of tax was on ordinary income in 2019. So what are some planning considerations that you can take away from this for 2020? Well, number one is to make use of the marginal tax rates. The premise of integration is based on income being taxed at the highest marginal tax rate. So until you're receiving income over and above the $210,000 range, you have access to marginal tax rates, and a lot of this discussion is not valid because the deferral opportunities are a lot less because the income is being taxed at those rates that Graham had shown earlier. If there's corporate surplus that does not need to be used by a shareholder in their personal capacity, and then a lot of consideration should be given to leaving that corporate surplus in the corporation in order to avoid having to pay tax at the highest marginal tax rate in 2020. The hope would be you reinvest it in the business to generate additional returns. And then in the future, when the highest marginal tax rates decrease, you would extract the corporate surplus in those years. Or if you're planning for retirement within a 10-year time frame, and you wouldn't otherwise need those funds, then that's where you can get a big win from the deferral. Because if you have high earning years while you're working, and then you leave some corporate surplus in the corporation, the years that you retire, your earnings would naturally decrease, and then you can take distributions from the corporation at that point in time and not have to pay tax at the highest marginal rate. As mentioned, there's a deferral opportunity, no matter how slight, on most types of income in BC. So it depends how much income you're talking about leaving in the corporation, or how badly you need that income personally to fund your living expenses or personal lifestyle. Maybe in 2020, the personal expenses weren't quite as much because we weren't able to do as much because of COVID-19. So you can leave more in the corporation and avoid paying that high personal tax rate. But let's say you need to extract corporate surplus. You could be looking at surplus stripping or triggering accrued gain on an asset that's held by the corporation to achieve a lower effective tax rate. This is complicated planning, so you should reach out to a tax advisor to discuss this. But you can reach effective tax rates of anywhere between 26.75% and just over 30%, depending on which strategy that you pursue. If you don't like leaving money in your operating company or your holding company, then you could, or you like to use your RRSP accounts, then you could make use of your RRSP account, which is another deferral mechanism. Income splitting is always something to consider, but with the new extended tax on split income regime, it's very narrow. So please talk to your tax advisor and someone who knows these rules to see if you can somehow qualify for an exclusion from the tax on split income regime. And then planning consideration that I always put out there, it's never too early to think about this, is setting up operating company, holding company structure that would facilitate keeping your operating company pure, removing excess cash or other investments from your operating company to remove it from any business risks, or to keep your operating company pure for use of a future sale and claiming a capital gains exemption. Thank you for your time today. Please do not hesitate to reach out to any of us if you have any questions.